Welcome back. This is, I can't believe it, week 4 already of the Home Investors Financial Training that we want to give you from Simple CFO. Have a super great one today. Honestly, Tony does a great job. If you don't know Tony, Tony's on our team at Simple CFO here, and he's got some exciting stuff for us. But I wanted to first recap what we've already gone over, and then just a couple things, and then we'll get into the presentation. Week 1 was how to think like a CEO. I spoke at that one. I'm David Richter. I own Simple CFO, and we're here. We want to give you the tools in order to think like a business owner, not just be a real estate investor. Everyone here, you're in the real estate world, you're in the real estate game, but the ultimate game you're playing is the game of money. And that's what we want to help you with, is being better at playing the game of money. So that was number 1. If you need to go back there. Number 2, foundation and profit first basics. Stacy Siegman was on here. She taught that one. The how can you get started with profit first, and just the foundation of some of the things you need to know right from the get-go. Last week was Eric Johnson. Week 3 was real estate deal analysis and profit allocation. If you missed that one, we got some great feedback on the last 2 weeks. And last week especially, just one person reached out and said that just felt like meat and potatoes, last week. That's where we're trying to provide as much meat and potatoes here as possible. This is not webinar fluff. This is not just some big sales pitch. This is like the stuff that we teach, that we want you to be able to get to a better financial place in your life, whether you're going to do it yourself, if you need to lean on someone like us. But we want to at least give you the tools and make you smarter and help you be smarter and take you on that journey as a business owner. Okay, so just to that was the recap. So why even listen to us? Just as another recap, Simple CFO collectively owns over 1,800 units in the real estate world. We've completed over 900 deals in the real estate world as a team, over 45 years of real estate experience, and worked with over 220 companies in the real estate space. And this is where we have a heart for making sure people understand where their money's going. I like the make, spend, and keep. Do you know what's coming in? Do you know what's going out? Do you know what you get to put into your pocket? So then from last week as well, too, several people move forward. I appreciate that trust. If you need someone that's going to help you on this journey, then you can go to that link. And Bailey, if you can help me, if you're in the chat, if you're here on our team, simplecfo.com/HV. If you need that, thank you, Bailey. Look at that. She was ready to go. I appreciate that a lot. I have no chat functionality again. If you are having issues with chat or video or anything, make sure you log in with the email that you were invited on. The email that you were invited on, that was also some people's issue for not being able to access the chat and that functionality. So I just want to make sure, if you've been here in the past and you haven't been able to be in the chat box, that might be why. So just wanted to make sure you've got that. So week 4 today, we are talking about cash flow management, which I love that he puts it, cash flow management, cash is king. This is making sure you know what to do when the dollars come in, where do they go? So understanding cash flow cycles, deal pipeline planning, making sure you know how to use profit first to manage investor funds and that investor vault. Like, we have a bunch of meat and potatoes again today. I was looking through this presentation. Tony does an incredible job. If you don't know Tony, Tony has been in the real estate space for a while. He's a fractional CFO on our team focused on the real estate investing world. And he is also invested in the real estate investing world himself. He has over 1,150 units across Texas and Oklahoma. So sorry if that's one of your numbers, Tony, and getting to know you, but that was one of the numbers I had written down as well. So this is a guy that is deep in the real estate world, but knows the finances and knows how to help. And this is where I'm going to turn it over to you, Tony. Thank you so much for coming on and sharing your knowledge and helping us with the cash flow management piece.
Absolutely, David. Thank you for that intro. I do have a quick slide by the numbers on myself. I'll get to that here in just a minute. First, I want to talk about what we're going to cover today. So I think it starts with what's even the importance of cash flow in a real estate business. And let's define what that really means too, because it can mean different things to different people. Once we realize the value of it in growing our business, what about strategies for actually improving and maintaining cash flow so we're not dependent on outside sources? Where does cash flow come from? Depending on the type of deals that you're doing, whether it's flipping, rental properties, or maybe other asset classes, the way cash comes into your business will look different. David mentioned profit first. So we'll look at how do we actually use that strategy, that methodology, if you will, to grow cash in our business. And then as we're all entrepreneurs and business owners, we got to do some forecasting. So what's a good way to forecast our cash flow as we continue to grow our business? So those are the things we're going to cover. Just quickly about myself, by the numbers. So it all kind of started in 1969. I'll say that. I'm dating myself. I've been around this space for quite some time. I've actually been in the real estate world since 2014. I started in the single family space. I always wanted to buy and flip homes, and then I quickly realized I didn't want to buy and flip homes. I really wanted a rental portfolio. That was really the end of the day. I wanted passive income. I learned the single family world in rental properties, and then another pivot. In 2018, I realized that I wanted to just grow faster because I was in a W-2. I wanted to exit that and be a full-time entrepreneur. So I pivoted to multifamily. That's how I was able to grow 1,150 units. What else can I tell you here? 2013, that's when I got married. I have 4 kids, 2 dogs. One of them's right there. That's Willow. I have been in the management consulting world for 25 years. I worked for companies such as Accenture, Ernst & Young, some smaller companies, learned a lot about investment management. You notice here I am a runner, so I only bring this up to say that a lot of being an entrepreneur is about lifestyle design. And so the Houston Marathon, where I used to live, Houston, has always been a passion of mine. I've run 21 Houston Marathons. That puts me at 160 people who have run more out of 8.1 billion people. Good company to have. It's a number to keep chasing. But I'm also chasing this number over here, which is 50 miles. I will be running a 50-mile race here in about a week and a half. Wish me luck. And I skied 17 days this year. I'm actually disappointed with that. I skied 32 days last year, but that's just because I'm running more miles this year. So it's all about lifestyle, life of an entrepreneur. I want to hear, though, about you. So I got a QR code here. Bring out your phones, or I have the link here if you need that. But I want to hear a little bit about your primary real estate business. Are you fixing and flipping? Are you wholesaling? Are you doing rentals? I'd like to understand kind of what's your primary business. You might touch on a lot of these, but help me with what's kind of been your primary focus, or if you're new to home investors in this world, what are you looking to really focus on? So I'll give this maybe 20 seconds and refresh the results. All right, I guess we know who's in the audience here. So primarily fix and flip, which not surprising here. Obviously, you're in the right place and home investors can help you with that. I should point out that the second home I purchased was actually from one of those We Buy Ugly Houses billboards. So I've been kind of around home investor franchisees for quite some time. It works. I think you all know that. All right, so let's talk about what is cash flow, first of all. Let's make sure that we're level setting on terminology here. So I do have one more survey for you on that topic. Pull out your phones again. So cash flow is revenue minus cost of goods sold, COGS. I'm sure you probably heard that term. Or is it income minus expenses? Is it money down the drain? Cash flow. I got the dad jokes too, David. Net operating income minus below the line expenses, or the difference between incoming and outgoing. Let's see what you all had to say. All right, a little bit of a split here, but the majority said the difference between incoming and outgoing. Yeah, I think as we start to unpack that a little bit, some of it comes from, are you defining this from an accounting standpoint? Some of us have an accounting background, or more of a business owner. Okay, ultimately, cash flow is the money that flows into and out of your business. Positive cash flow, building up the bank account, and negative cash flow is draining your bank account. Now, we all don't just run our businesses on cash alone, but maintaining, I'm going to call it runway of a healthy cash balance is an important part of the business for many reasons that we'll talk about. All right, revenue minus cost of goods sold. Now we're talking about accounting here, right? That equals gross profit. And we're going to talk about why you should care about each of these in just a minute, but that's the definition of gross profit. Income minus expenses from an accounting standpoint. That is net operating income. We call it NOI. NOI minus, so you can almost see me like working through your profit and loss statement here from top to bottom. NOI minus below the line, so those items that are below your NOI line, such as debt service or capital improvements on, say, rental properties, that is your net income. Okay, they're all accounting terms, not necessarily cash flow management terms. But why should we care? So the importance of cash flow in a real estate business. Okay, first off, let's look at some of those terms we just talked about. Gross profit. Why do we care about gross profit? Gross profit measures the cost effectiveness in delivering your product or service. And in your case, since the majority of you said flips, we're talking about your margin. So you bought it for X, you put Y into it, and you sold it for an ARV of Z. The difference is showing how effectively you were able to keep your construction costs down, keep your hold time down, and drive for the highest price by you being smart about the things you put into it. That's gross profit, and we really care about that because that's our starting point. The NOI, net operating income, is important because it measures the effectiveness in controlling your overhead. So you have operating expenses to run your business. Whether you have a deal or 10 deals or no deals, you still have overhead. And so NOI is showing not just how effective you were in your product, aka flipping properties, but controlling expenses for the size company that you are. And then at the end of the day, where the rubber hits the road, net income is a holistic profitability of the business. So we take gross profit, we subtract out our operating expenses, and we have a net income, which obviously matters from a effectiveness in growing the company. It's also got a tax implication. We're not going to go into taxes today, but is something for you to think about. All right, so what about cash flow? So cash flow, I mentioned the word runway already. It's a runway for you to run the business. If you've got, say, $120,000 sitting in the bank account and it costs you $10,000 a month in overhead to run your company, that's basically saying, how long can you last if you don't get a single deal, right? You have to understand your runway and how much cash you have to work with. Okay, without cash, you can't pay your bills. You're waiting to close on the next deal while you're draining your bank account. That's a stressful place to be. If you can't pay your bills, then the alternative is you start searching for loans and lines of credit. And if you can't bring in more cash to pay the debt, then all of a sudden you're building liabilities, and that's a dangerous place to be. I'm not saying don't ever use debt to run your business, but we want to make sure we're using it smart. Okay, so cash flow is super important. So let's talk about strategies for improving and maintaining positive cash flow. Okay, if you can get your phones out one more time here. What strategies might you implement to increase positive cash flow? I'd like to hear from this list here. What are you doing? So we got to increase prices, whether you're in the flipping world and charging more for, your sales price, or if you're dealing with rentals, increasing your rental rate, reducing your overhead expenses. What about self-managing properties? I know in the rental space, that's kind of a lean into. Some people either start there and then graduate up to working with a property manager, or sometimes people learn that third-party property management isn't all that it's cracked up to be and decide to self-manage afterward, maybe building systems and teams. Some people want to do the rehab work themselves. Maybe you come from a background of construction. And then there's the cash out refi. So if you have assets, you potentially could increase the cash in the bank by doing a cash out refi. Oh, let's see what you said. All right, reduce overhead costs seems to be the winner there. Okay, but there are a few people that are self-managing and maybe doing the rehabs themselves. So let's kind of unpack this a little bit. All right, so increasing sales price if you're flipping, or increasing rents if you're holding. I got a question here of what we should consider with this strategy. And by the way, I unfortunately through Teams can't see the chat. Feel free to put questions in the chat. Maybe David or Bailey could interrupt me if there's something we need to address now. Otherwise, we'll take your questions at the end. We'll have enough time for Q&A. But this is almost a rhetorical question here, because I think you all realize if you increase the price when you're selling your flip, chances are, if we're overpriced, that property is going to sit, which really just means that either we're increasing our hold time and hold expenses, or we just may end up staying there too long and have to reduce the price, and then we look dated and old and stale, and what's wrong with our property, and it's just not a good place to be. You typically want to price it right from the get-go. Now, a lot of you said reduce overhead costs. Absolutely. I mean, there's plenty of places we could start to reduce or eliminate costs. And when I'm working with my clients at Simple CFO, we do something called an expense analysis, where I pull all of, let's say, last year's costs. If we don't have a full year data, we annualize it. We try to look at what's a typical monthly run rate for each of those expenses. And is there something that could be reduced or eliminated? I think a lot of common ones would be like software and subscriptions. Chances are, especially if you've been in business for a long time, you probably have a lot of those, and maybe there's overlap. Maybe two pieces of software essentially do the same thing, or could do the same thing, and maybe we could just eliminate one. Sometimes, we cancel credit cards and we realize that we didn't even have some of those subscriptions, or we didn't know about them until the payment doesn't go through and the vendor starts to reach out to us. That's actually a good thing, because then we can decide whether or not we want to pursue it. Okay, now there's some more questionable, I'll call them riskier overhead costs to reduce or eliminate. First one that comes to mind there is staff, payroll. Right? Payroll is usually one of the biggest expenses that we have. But if we start reducing that, then either the quality of what we're doing and delivering can go down, or we as the owner end up picking up those responsibilities. And so it could be done. Sometimes it needs to be done. But I think David probably shared some of this with you early on in his conversation about being a CEO. None of you got into this business to be in the business. We're really focused working on the business and growing a business. That's the greatest value you have as a CEO. So it is a little bit risky to start taking on the detailed responsibilities. Okay, self-managing properties. I think this comes in two flavors. It could be you literally showing up and, turning a wrench, or it could be you building a team to deliver the same service that a third-party property manager would do. So third-party property managers, many of you who've explored this realize it's a percentage of revenue in most cases. You can do the math and determine whether that's a good use of your capital, or if you're going to be in the rental space for a long time, maybe it makes sense to hire people who can work under your direction and grow your own property management business, whether that's just your properties or maybe even considering taking on other people's properties to cover some of your overhead. Okay, obtain your general contractor license. Look, if you have it, that's wonderful. But if you don't, and you're thinking about getting it to save some costs, again, this is one of those you could slide back into doing the work yourself. Ask me how I know. I used to have a property where all of my tenants thought I was the maintenance guy. I eventually, no exaggeration, I had to take my tool belt out of my truck. That was, they ripped the Band-Aid off. And I was literally driving there on a Sunday afternoon because somebody's toilet broke. And I called my PM and said, call the contractor. I'm not doing this business so I can go fix somebody's toilet. So just a lesson that I learned early on. Cash out refi. So this is a way to infuse cash in your business. Why would somebody do that in today's interest rates if you need cash, right? Because you can always refinance later. Obviously, your monthly payment's going to be higher if you have a higher interest rate, but if you want to tap into the equity of your properties, that will infuse cash. We can have a whole separate conversation about asset protection and how much equity should you be keeping in your properties in your portfolio. That's maybe a separate topic, but I do think that it is a strategy to consider. Just maybe not the first thing I would go to. All right, so here's some creative strategies for increasing cash flow in the business. Affiliate relationships. Okay, think of the wedding planner. When somebody goes to a jeweler to buy an engagement ring, kind of kicks off the process. And there's all these people downstream, from the wedding venue to the DJ or the band, to the florist, to the cake baker, all these different businesses that are in this called a daisy chain. And people who are in the wedding business are very familiar with knowing their place in the daisy chain and having relationships pre-established with people upstream and downstream. And there's financial benefits of those relationships. Okay, so nothing shady about this. It's really just, working out those relationships and what compensation there could be, and making it a win-win for the customer. Because if the person who's getting married doesn't have to necessarily worry about finding all these people through referrals, they kind of have a full palette of services. That makes it easy for them. Maybe there's even negotiated pricing for them. So it is a win-win. In the real estate world, we got to think about who's upstream, who's downstream of the work that we do and where we are in the daisy chain. Okay, so I'll leave it there. Just be thinking about, who do you work with on a regular basis? Improving the gross margins, okay, reducing cost of goods sold. So I'm not sure these days what the rule is that HomeVestors uses. Maybe it's the 70% rule. I think that's what Bigger Pockets teaches. There's all kinds of different underwriting approaches to looking at how we put our deals together, how we come up with our offer prices. But I think at the end of the day, it's all the things that go into your gross margin, from where you start your purchase price to your closing costs at acquisition, to your rehab and how efficient you can be with supplies, materials, and services. And I know today everybody's facing all the tariffs and so forth. It will disrupt the industry to some degree. We're going to have to plan for that. Okay, so all these things factor into your gross margin. And so there's lots of creative ways that we can bring those costs down. Eliminate redundant overhead costs. So we talked about software and subscriptions as an example already. There's a lot of general administrative costs as well that typically fall into this. It's easy to have overhead inflation. We see some success in our business. We think, hey, we're making some money, no problem. We can spend here and there and so forth. And then we all know we go through these cycles. We get into a slow period of the year. We still have all these expenses. Maybe they balloon to a place where it feels uncomfortable to bring them down. Okay, but this is where hiring a CFO sometimes can hold you accountable and not necessarily cut into the quality of your services, but if we've got redundant costs, we really need to look at possibly eliminating those. Evaluate and negotiate. So especially if you have assets you're holding, there's lots of spend there from insurance and utilities and even lenders that you're working with and so forth. Shop around. You know, when you go to events, talk to the people at the tables and the booths and so forth, and see where you can build your sort of portfolio of vendors that you work with. Lenders often have great deals if you keep bank accounts with them or do a certain volume with them. So don't be afraid to ask for a discount on everything. All right, so where does cash flow come from? So this is an example of a P&L that I pulled. And I've circled this one here. This is the purchase price. Okay, you see it listed under cost of goods sold. It's the purchase price for a property that is showing up here in November. So I'll cut to the chase here because there is a difference between accounting and cash flow. This is what happened. That's what accounting says. It's in the past. It doesn't even show up here on the P&L until we've sold the property. But guess what? You've been incurring expenses along the way until you sell it. And your bookkeeper has been putting those expenses on your balance sheet. And maybe you're not necessarily staring at your balance sheet every day, but they don't show up on your profit and loss statement until the property's off the books. So again, it's in the past. It doesn't really help us to manage cash flow by looking at your P&L. Then there's this concept of cash versus accrual accounting. Okay, so we started looking at, I think this is a rental example here. You know, the concept here is like if I look at each of these months, it's not necessarily even because I might have some expenses that I'm paying, let's say taxes on a property, and maybe I'm paying them once a year. Okay, so if we're not doing accrual accounting or managing on a cash basis, we're going to see lots of ups and downs, lots of spikes, and we need to plan for that. I'm not saying you have to use accrual accounting. I'm just saying if you don't use accrual accounting, then we need to plan for that because that's cash flow. You're paying the taxes, the money goes out of your bank account at a certain time of the year, and we got to replenish that. We have to make sure it's there to begin with. All right, using profit first. I know previous session you had was on profit first. Let's talk about how it applies to cash. So if you might remember, all of your money comes into the 001 deposit account. This could be rent. This could be proceeds when you leave the closing table on your next flip. Okay, so the money comes here. Pass through 002 account. This is in the flipping world. This is setting aside money for rehabs, for holding costs, which could be mortgages, it could be utilities, insurance, maybe you're paying an HOA. In the rental space, you know, you might have repairs and maintenance, you might have property taxes. Okay, so they all go here. This is all your real estate activities in the pass-through account. Then the difference between what came in and what we're putting aside for our real estate activities is what we call real revenue. And that real revenue gets spread across these other accounts, which the first three, profit, owner comp, tax savings, these are your owner benefits. This is why you're in business. You're trying to set money aside for profit. You want to pay yourself for the work you do in the business. And then because you're making money, again, net income, you will have a tax liability. We can talk about tax strategies to try to reduce that tax liability, but let's just say you have it. Your business should set aside the money to be able to cover that. And then, of course, you've got your overhead, your operating expenses, and we all want to have a reserve. Reserve is there to maybe cover the slow months. So especially in the flipping world, when we go through lots of cycles throughout the year, maybe homes aren't really selling in the first quarter, maybe things slow down in the last quarter. So we've got to make sure that we have reserves to draw on in the slow times. Okay, so that's kind of just a high level about where this cash is going whenever we close on a deal. Now, the actual percentages we work out by looking at what are all your needs. What are your overhead expenses compared to the real revenue that you're creating? How much profit are we really looking to try to get out this quarter, this year, and so forth? Okay, so we set up a plan for you to be able to allocate that money wisely. All right, so we know what cash flow is. We know why it's important. Let's talk about forecasting. So if you pull out your phone one more time, I got another question for y'all. All right, what do you believe are benefits of cash flow forecasting before we really get too deep into it? So we got understand runway to operate the business, estimate your income taxes, calculate your net worth. I don't know if anybody's got a personal financial statement, PFS. Allocate funds to the right buckets, profit first. Monitor the health of the business. What do you all think here? All right, kind of split. So understand runway to operate the business. Allocate funds to the right buckets, absolutely, and monitor the health of the business. Those are our top three. All right, I made this you can select multiple because it is many of these. I mean, it can really help in a variety of these. But let's unpack it a little bit. Okay, so cash flow forecasting techniques. We want to consider all ins and outs and the timing. Okay, so a lot of times when I'm working with a client of mine, we're looking at how much are we spending in the next 30 days, 60 days, and beyond. And then looking at, okay, if we're flipping, let's say, the money coming in the door, we get a property on the market. Is it just on the market? And given our understanding of how fast, days on market properties will sell, when might we close on it? Or, hey, we're under contract. So now we actually have a closing date. We need to understand when money's coming in as well as what's going out. Rental's a little bit more consistent, right? Because I know we're all chasing collections and working with tenants to stay on time. But really, we know roughly what's coming in. It's usually, hopefully, coming in on the 1st, but maybe, by the 10th. We can predict that a lot more consistently than flips. Flips have initial costs of acquisition. That's something to bear in mind. Sometimes we get that funded by maybe a hard money lender or a private lender, but we also need to consider that maybe we're in a market where homes turn fast. Maybe you've got your contractors dialed in, and you can get something in and out in 90 days. Sometimes I have a client of mine that's in a market that has a lot of permitting issues. He can hold a property for a year. And so he's got to factor in extensive carry costs for the life of the project. Okay, we got our rehab costs, and we also have to factor in disposition costs, right? All these are areas where we're spending, and they will be spent at different times along the life cycle of the deal. Okay, the flips, the hold time, again, know your market. What's the typical days on market and the seasonality? Are we in June or are we in December? Right, that's going to fluctuate. Consider the construction spend profile. Okay, so in other words, what I mean by that is, let's say your rehab budget is 50 grand, and you know that you're going to get your contractor, shows up, and day one, they're going to do demo. And then maybe that takes, I don't know, a couple days, maybe a week, depending on the project. And then you're going to move into your rough construction. And then you're going to move more into kind of final construction punch list. Right? All these stages in the construction, you're going to spend some or more at different points. And so that's something to budget for. You don't necessarily have to pay the full 50 grand in the first 30 days if the project's going to last 60 days. Okay, and I'm sure you've worked out deals with your contractors of how they want to get paid. These are all things we want to understand so that we can keep running our business and know how much money has to be set aside. And then the outside capital. So if you've worked with hard money lenders, let's say, you know that typically you can draw on a construction budget. You may have to have pictures and inspections and submit your draw requests, and that takes a certain amount of time. These are all parts of you forecasting how long it will take before the money comes in. So we build all of this into our cash flow model, so we see that money's not just coming in when we sell, but cash is coming in when we take draws on the loan. Okay, so we're kind of wrapping up on our time, and I want to leave some time for Q&A. So let's try to wrap things up a little bit here. Just to recap some things that we covered. The importance of cash flow in our real estate business. We need to try to have a certain amount of runway. We need to be able to predict that so that we're not going out and just running the business off of debt. Strategies for improving and maintaining positive cash flow. Remember things like negotiating, removing redundant expenses, where are you in the daisy chain, affiliate relationships. These are all strategies for improving cash flow. Where does cash flow come from? It is important to understand the accounting, of course, but that's after the fact. So having a good cash flow model and forecasting when you're spending and when money's coming in will be super important. Profit first is a great structured way to get into a habit of not being emotional about taking the money and putting it somewhere, spending it in a certain way, but having a system in place so that every time you sell, I'm making this up, 10% goes in a profit and maybe 50% goes in your operating account, because that's the need and that's what we've designed. You don't have to think about it. That's just the process you're going to follow. And then cash flow forecasting techniques. Lots of different ways to do this. The best way to do this is what I call a pass-through revenue cash flow model, looking at acquisition costs and how do you get properties in your inventory, how much are you spending, rehab, holding costs, dispo costs, and then thinking about money coming in, draw money from loans, dispositions when you sell. Okay, these are all ways to keep track of your cash and be able to continue to grow and feel comfortable too that the money is going to be there. You have enough reserves and runway to grow at the pace you're comfortable with. Okay, with that, I am going to flip it over to David for a few minutes, and then we'll go into Q&A.
Awesome. Thank you, Tony. So yeah, if you could help me with the slides as you're presenting here. So why Simple CFO? Like, why are we doing all this? I just wanted to say, first of all, Tony, that was incredible. I feel like this was more meat and potatoes and like actionable items of how do we get more cash in today, or how do we make the bottom line more positive, or even like you said, how do we get cash flow in? Like that's the number one thing I feel like when I hear and get on these calls is why people lose sleep at night. It's like, where's the money going? I don't know. It's like being able to take a breath, slow down, and say, okay, where do we stand right now? Where are we going for the future? That's why I want to reiterate here. If you were here before, I did like a little pre-presentation at like, I don't know, 11:45 Eastern, right before we got on, about the business hierarchy of needs from the book Fix This Next by Mike McCowitz. And a lot of people, they do this. They have sales, but then they skip to order. They have the sales, they make the money, they get a property to close, and then they reinvest everything back in the business. And then they have no money for themselves. They have no money to make sure you're being paid, that the business is supporting you. And that's where a lot of people skip that step. So this is why we're doing this. Why Simple CFO? Why are we a part of Home Investors? Honestly, I had a great person last week tell us like we love that Home Investors is helping us keep this money and like the focus of making sure we know where every dollar is going. They do. They want you to make sure you're focused on that creation of stability. That's what it says right there next to profit. Sales is that creation of cash, but then that profit is making sure you're stable, that you can reinvest in the business, you can pay yourself, you can do those things. Tony gave you a lot today of what can I do with the cash today, and like how can I make my cash position better? What are some things I can cut? What's some things I could potentially make money on? How do I make sure that I don't go out of business while I'm running all these rehab projects? So that's where we wanted to put that. And then Tony, can you move to the next slide there? So then the role of a fractional CFO, like what does an actual fractional CFO do? They are kind of like that crystal ball. Like I want to know what's coming to for you to be a good CEO, to know what kind of questions you need to ask from the financial section and from the finances of your business, where I get it. This is not usually the most exciting topic like the finances, just in general, when I go out there and speak and do all this stuff. And this is where though true financial freedom is made, is knowing where the dollars are going. So you need that financial strategy. You need to have a forecast like Tony was talking about, but also where's your money gone? Like, do we have a budget? What's come in? And are we close to like what we actually projected to what we were doing and what we wanted to do? And then making sure we have the cash flow in place. And then you identifying the ways, just like Tony did today, of like improving cash flow. The difference with working with a person versus what's happening today is that it's specific to your company at that level. So knowing and going through that, like Tony said, doing an expense analysis of going through every line item like that. So that's what a fractional CFO should be doing. So Tony, can you go to the next one? I think it's a picture of a little GPS. That's where a lot of people have rear view mirrors in their company. You have a bookkeeper or a CPA. Honestly, some people don't have those people in place. If you don't, you need those. The CPA slash tax professionals there to keep you out of the orange jumpsuit. The bookkeeper is there to make sure the day-to-day is managed and you've got your numbers in place. Where a CFO takes that all together so you don't have to become a financial wizard to put it all in a good package to say, where have we gone? Where have we been? Where am I now? And how do I get there in the most efficient route possible with the money, the time, and the resources that I have to be able to forecast? Like, how do I get to point Z without going, like running into the mountain, but I should go through the tunnel or I should go over the mountain depending on what's happening. That's what we want to do from the financial perspective. So how we do that, Tony, on the next one is that Simple CFO, we do three main things. It's hard to see there, so I'll just talk about it. Number one, the CFO leads your financial team. We lay the financial foundation. So making sure you have a good bookkeeper or CPA or tax person in place. If you don't have that and you come to us, that's the first thing we're going to make sure you do have. So if you're like, well, I don't even know my numbers, I don't know where to start, when should I reach out? Because like I have nothing in place. We've had people reach out over the last few weeks that had nothing in place that we're working with and getting that all set up and helping get on the right path. If you have that that stuff set up, then we go through profit first and make sure you know where your money's going. And then we set up a dashboard, which is a lot what Tony went over today is in our dashboard, tracking the cash flow, the rehabs, the expense analysis, knowing where every dollar is going, running profit first. That's what we're doing. So Tony, if you could switch to the last slide there. That's where Bailey put in the comments. If you want to book a call with our team just to see, is it the right time? This is where you stand right now. If you just need some help or like walking through your situation, we'd like to be there for you. We'd like to be that resource that's not just going to talk to you about the past, but like where are you now and where do you want to go and how do we point your finances in that direction and make sure you're actually headed in the right direction. That's what we're going to do and hold your hand there. And that's the difference, like between this training and one-on-one, you get an actual CFO like Tony, someone like Tony that's going to be on your team, that knows real estate, that knows how to help you get to that next level. And so you don't have to worry about the financial side anymore. If that's what you're worried about now, or cash creation or cash preservation, that's what we can do. And that's what Simple CFO is here for. And if we can help you, I want to, and I want to just have that conversation. If you're not doing deals, the first things you should do is get some of the resources from the first few weeks. Like if you're just new and you're just getting started, and this is like maybe your first few months in Home Investors, like if you start there, we have some good resources that we've given out. If you're already down the road and you're making money, you're making at least, I would say 100,000 in gross profit. So not net profit, but above the line, like what Tony was showing you, that property profit. Then you can reach out and we can at least have a conversation, see if we're a good fit, or we can pin you to the right person. If we're not a good fit right now, we've turned people away, many people. So we want to make sure that you get that help. And if we can be that for you, and if you need that one-on-one interaction, that's what we're here for. Here's a teaser, okay, which is cool because Tony's speaking again next week. So here's week 5. Week 5 is going to be about operational and financial systems and processes. What Tony said was profound. Like everyone here today who is a owner of their business wants to act more like the CEO. So you need to work on the business versus in it. Tony, with what he was talking about today, was how to think about the finances like a CEO. What questions do I ask? How do I create more cash in the business? How do I become that? You, by being on this call, you are working on the business right now, working on the financial side of your business and becoming a smarter, savvier business owner. So next week, we're going to be talking about how do I systemize some of this stuff? So that way you're not in it all the time and thinking about it. What I would hate for you to do is take away from this 10-week training that you need to go back and add like 15 hours to your week just about the finances. No. You want to have systems in place. You want to have profit first to manage the cash. Tony's going to teach you some other things as well next week too that are really cool. I want to give you just some of the points. The need for holding employees accountable so you're not wearing all the hats, the time versus cost benefit analysis, team training, plan, communication, progress tracking, the bookkeeping and chart of account setup and financial softwares to use to make it a lot less headache in your life. Here's another one, financing your real estate business using the investor vault funds the right way. And then types of business loans and lines of credits. Those are just some of the high level things that I wanted to give out there and some of the points from next week if you're going to be here next week. If you'd like to reach out, that's the link there, or it's also inside of the comments and in the chat as well too, which I can actually see the chat today, which is great. And then also, Sam told us mics and cameras have been put in, or you can turn them on if you have a Q&A or question or what, if you would like to ask Tony or myself, which I think we already had one, Tony, but I think Bailey already answered it. It was about the daisy chain and like what are specific type daisy chains that they might find in the real estate space or around there. And Bailey had a good answer. I also was thinking too, some people, if you can get the deal in the door, sometimes need help on the back end. And so it might be a dispositions help. And like maybe you're utilizing another Home Investors franchise to do that and to help you, get rid of the deal or, to make sure that you can sell it. Or if you're the wholesaler, like, is there someone in your area that can flip it and that's who you're flipping it to? Those are some on the actual selling, but Bailey put a bunch of good answers in there about the title company, real estate agents, the legal accounting side. Because like if you send someone to us, or something like that, like things like that you can do that can add the cash flow to your, to your bottom line as well too. So Tony, I don't know if you have anything else on that. Otherwise, I'm just going to see if there's any more Q&A that pops in the chat.
Yeah, no, that's a great list. So thank you for that, Bailey. That was one of the first things that popped in my mind was title companies. I mean, I used to work with so many title companies, and then I just started working with one, and I got priority as well as a great price. And anytime I brought business to them via people that was in my sphere, I mean, you guys have a network of people that you're working with. They're all closing, in markets that you're in, or even working with national firms. I mean, that's something that you can benefit from. You bring people business and you're going to earn something, or even if it's not straight up dollars, it's service. So good stuff.
And vice versa too. Don't forget to ask people in your daisy chain if you can be part of theirs as well. Like, is there a way to get a referral from them? Or if you've got several different things, we've worked with several home investors franchises that had like they also have a title company and they also have this over here and like they also have a construction arm just for construction, but not, just to close, not just for their own deals. So if you also are that and you've got several things going on, don't forget to be a part of other people's daisy chains as well and like reaching out. Sometimes you have the answers to your current problem in your phone, like in your contact list right now, and it's just taking the time to think about it. I go back to week 1, thinking like a CEO. Step number 1, you have to have time to think. So remember to build that thinking time in your schedule, block it off. What are the best things to think about this week? So here we go from Bailey. This is a common question I hear from my clients that might be, how do you balance keeping cash reserves on hand versus reinvesting into new deals? Ooh, that's a great one. Tony, I'll let you run with that.
Yeah, yeah. I mean, that's the most common question, right?
Yeah.
Especially when maybe we don't have a lot of deal flow and it's one or two deals that are taking a long time. They're not selling. We started the company with a little bit of cash, but now we're waiting. We're waiting for that sale. How do we go and make another acquisition? So I would say that if you start to put these into a model and you already know how much funds you're going to be setting aside for the next deal out of the proceeds you make in this deal, that then kind of backs you into how much can you afford for overhead, right? So it starts to give you a discipline of keeping your expenses at a certain rate because you know what kind of proceeds you're going to get in. Maybe early on, depending on how fast you want to grow and you don't want it to all be organic, you can leverage some debt. So we'll talk about that in the next session next week if you can attend that. When I say debt, it could be a line of credit. It could be bringing on investors. It could be bringing on investors for a single deal and a promissory note and a lien, or it could be more of a fund model where you're trying to grow your business by, bringing on people who will participate with you for a longer period of time, whether that's a debt fund, an equity fund. It is something maybe a little bit more of a mature kind of advanced tactic, but I do see a lot of my clients kind of jump right into it because they're looking to grow fast.
Love that. And I, if you've ever read my book, I wrote Profit First for Real Estate Investing. I think I dedicate an entire chapter to this one question of, like when should I reinvest and should I even keep cash reserves? Because a lot of us are real estate investors. We want to go out there. We want to spend every dollar. Like we want to get all the deals we can, right? That's like what we're all about. And so in chapter 6, I literally call it not spending every dime will help you scale profitably. Because I know, because I've lived that. Like Tony had mentioned, like we've lived this type of stuff and we want to help you make sure you know where those dollars are going and like when can I reinvest? And I give several things in here. Here's a statistic from Chase Bank. Like the average business has 27 cash days a buffer, like in their bank account, 27, so less than a month. That's the average. The average business has less than a month of cash on hand. And I give several things like why in the world would you ever have cash reserves as a real estate investor? Reserves are the way to profitable growth. It offers security for your people and it provides peace of mind for yourself. And then I even go into which accounts, if you set up profit first, should start to accumulate reserves. Because I say you shouldn't just have reserves for the business. You should have reserves like if you set up the owner's comp bank account or the owner's pay, like to make sure you're paid, you should start stacking some reserves there. So if something goes wrong, you can still pay yourself. Or if that deal doesn't close, like in this month that you were banking on, you still have some money there as a buffer for you and to pay you. So there's also that as well too. So are you protecting, yes, your company, but then are you also protecting yourself as well too? And then it's like, okay, if we have some cash there and we have some extra reserves, like when is a good time to grow? And then that's where I give some of the charts and stuff inside the book, which does not translate to me speaking as well. So if you want that, that's in the book. I think we've given that at one of the ones. It's part of the Profit First cheat sheet over the last couple of weeks. That should be in the Home Investors folder. So if you have that, you have access to the book. So if you want to read chapter 6 over that question specifically on reinvesting versus cash reserves. So let's see. Fractional
David,
CFO.
if I could just add one more thing on that. So I have a client that's pretty mature. They've been in this business for a long time. They're projected to do between 13, 15 million in top line this year. They always have at least 8 to 10 deals they're working at any one time. And just recently working with them, and we saw the drain on cash because of this point in the cycle. Okay, we're just getting into Q2 where things are starting to pick up and we're having more dispos. They invested heavily in the first quarter on acquisitions and rehab to get properties ready for the peak of the season. So they're a little strained right now on cash. And so the way that we're approaching that is, okay, we have choices for who we use to fund new acquisitions. We could go with somebody who charges a higher interest rate but covers 100% of purchase price and rehab, or we work with somebody who's got a lower interest rate and maybe more lenient terms, but we got to come up with 20% down payment. Which one do we want to go with? Which tool do we pull out of the tool belt given where we are in the market cycle? Okay, so that's just, every day, no matter how mature you are in your business, we're constantly looking at, okay, how much cash is in the bank? How much runway do we have? Is it 27 days or is it, 270 days? And we're looking at which tools to use for which situation.
Love that. Love the specific example. And that's an example of when I hear, I don't even know what to ask. These are the types of things where you might have to get someone that helps you to know what to ask like that, or like to be able to pinpoint where are we in the cycle and making sure you're making the decision with the whole picture and not just what do I need from this one deal, but how does this deal fit in, to the overarching structure. So there we go. Tony, do you see the other question for fractional CFO? Do they help with tax filings? Do you help set up debt equity funds? I know for us, Simple CFO, we do have CFOs on the team that can help with that and with the tax filings. If you come to us, it's the fractional CFO service. And if you need bookkeeping, we have it. And if you need the tax side, we have that as well too. So if you need those things, you can come to us. The CFO more runs quarterback. I don't want the CFO filing the taxes. I don't want them doing the books. They should be doing exactly what Tony was talking about today, like giving you the best bang for your buck of knowing where every dollar should go and getting you to where you want to go as a business owner. And then the debt equity funds, that would be a one-on-one type thing. And do we have a CFO available to be able to help you set this up? Do we have one with that experience? Being able to do that. So that's where it's like right now in ours, if you get on a call, we can discuss that one individually. Any other questions? Let me see in the Q&A. I haven't popped over there for a minute. Nope. Awesome. Any other questions that we can help with while you've got Tony and myself and the team? There are specific examples of common daisy chains find yourselves in. So besides the one that Bailey gave, is this one for us to answer, or do you want like Sam or other franchisees? Because I know you, Ian. Hey, Ian, I'd love to see your face. It'd be cool. Are you there? So I want to make sure we're answering it like you want us to.
Hey, David.
Great.
Yeah,
There you are.
No, sorry, still finding my way around Teams here. No, just daisy chains. Like Tony, that was I mean, first of all, thanks for all the great content, but that was a question from earlier that just jumped out of my mind. Is that's just a question. It's a thought that hadn't even crossed my mind before. Um, and great questions get great answers, right? So it's just learning to see the opportunities that are around us, right in front of us, that we don't see them. We haven't learned to see them. So that was where that question was coming from. Is uh, are there daisy chains that exist that are common to home investor franchisees in this fix and flip space? Conversations that we could have today. Pick up the phone, ask this person this question, see if it gets you, if it makes you, makes you or saves you something, right?
Totally, totally. I think if you just start looking at all the places that you spend money, and or maybe this is overlap here, people are making money on you, right? You have to kind of look at all the interactions that you have. And if you're flipping, you might be flipping to retail, in which case you're working with agents, right? So there's a very common point in the daisy chain. Who you're going to work with, how you're going to structure commissions, and so forth. And then, of course, on the front side, you're working with contractors every day. They're not just making money on you, they're making money on other people like you. So how can you bring them more business to benefit you? How can we work out a structure that is going to financially benefit you? Or even if it's non-financial, you get first priority, you get your deals done sooner. I used to have a contractor that literally every time I picked up a property, I knew it was going to be 2 weeks in and out. They would be there 24 hours after I closed on the acquisition. That was something I could count on. And while it may not have been dollars in my pocket in the way of like an affiliate or referral fee, I knew that time is money. And if I could get it in and out in 2 weeks, I was going to get it on the market a lot sooner.
Mhm.
Right?
Yeah, gears are turning, and everyone in the audience too. I mean, invite you to think in these ways, just to kind of get the creative juices flowing. Because I've heard of other operators wrapping vehicles for their, or buying a trailer and wrapping it for their contractor. Again, this is all off the top of my head, and I'm not doing these things. Um, a guy I'm working with right now, he's overcharging me for materials. I could probably get on board with the Amazon business account thing that we have through our vendor resource. I mean, that saves. I don't know if that makes money, right? But I don't know.
Yeah.
So
Think about it too, like if you're doing a lot of volume, then ideally you have supplies on hand, especially what's kind of coming down the pipe right now. I used to work with Lowe's a lot, and I would purchase considerable volume with them, and they would set a container in their parking lot for me, for my stuff. And it didn't cost me anything, but they would do that. And then my contractor could literally show up, give his ID, pull from inventory. They would manage all the inventory for me and give me the reports. If I was being charged for that, then let's say I dropped my own container somewhere. And if I wanted to offset the cost of that container because maybe I didn't need all of it, could I rent some of that out, or rent a storage unit somewhere that's close by to where I'm doing a lot of work, and then I don't have to pay somebody else for it, right? And I could offset the cost of my storage unit by sharing that with somebody else. Just lots of
okay,
creative ways to do it.
cool. Yeah. All right. Well, yeah. Thanks for entertaining the question, guys.
We're also here not to answer every question, but to help you think and ask better questions like you did, Ian, of like maybe at the summer summit or at, like pick up the phone and call your DA or call, like calling the people in your area and like saying, okay, what other ways have you done this? Or like, what do we think we could do here together? Or like, is there someone else in my area that I should be talking to? Being able to also get on the other side of like, I want to be the CEO. Here's a great question to be able to ask. What what money am I leaving on the table literally just because I didn't pick up the phone? and didn't call, this person or just didn't have this conversation. So that's a part of it as well. Then Tony, there's another question for you in the chat from Jeremiah Johnson. I want to make sure you can see it.
I see that. Yeah. So Jeremiah, the way I would think about this, I don't have a particular number. The way I would think about this is in a couple different ways. First is asset protection. So if you're adding properties to your portfolio for the long term, you want to have a good entity structure in place to protect your assets. The more equity you have in your properties, the more exposed you are. A litigious attorney is looking for equity, right? They want to liquidate your assets and take, what they can get in cash. So you're always going to be more exposed that way. I'm not saying rack up, a huge debt leverage just to avoid that, but you want to consider that if you're going to be in the rental space for a while. I would also say common sense of you want to make sure you have positive cash flow. You don't want to be so leveraged that you are spending money for the benefit of having assets in your portfolio. So we have to make sure that we have a decent amount of cash flow. Beyond that, I'd say just really look at the portfolio level and not just one property at a time. Are there ways that each of the properties can support each other to grow the portfolio? So maybe down the road, we can consider things like portfolio loans. We just, lots of different strategies here, but no specific number.
Cool. Any other questions that we could answer before we shut it down for the day? Check Q&A one more time. Nope. Okay. Well, thank you for coming, Tony. Looking forward to next week as well on making sure you know how to systematize some of this more inside of your business so you're not running around like a chicken with your head cut off. So we want to help you get there. Thank you so much for being part of this. Have a great rest of your Monday. Thanks.
Thank you, David. Thank you, Tony.
Of course. Thank you all.